morning to everyone watching live on BAM YouTube. Hit the thumbs up so this video reach more people, and let me know in the comments where you are tuning in live from. The hot sheet covers what you need to know about the real estate industry in a 24-hour time period. On today's hot sheet, I will cover capital economics, housing market prediction, some good news about inventory, a Florida condo law, and a 10-year Treasury yield that is going up. Today is Tuesday, January 17th, 2023, and the hot sheet starts now. All right, here we go. Hit the thumbs up button if you're on YouTube so that this video reach more people. If you're a real estate professional, if you're an investor, an attorney, appraiser, this show is for you. This is your hot sheet to get a look at a 24-hour time period in the real estate market. And jumping right in from Fortune, the article is from Lance Lambert. The free fall in housing market activity just concluded, says Capital Economics. Okay, so we've seen a decline in sales, a dramatic decline over the last 12 months. We didn't see record sales over the last couple of years, but we did see near record sales during COVID in the amount of transactions in the real estate industry, in housing. All of a sudden, interest rates go up in June, and we see those sales come to a screeching halt. I've coined it the Cold War of real estate. If you're a seller, why would you sell? You're likely going to be a buyer. So there has been a freeze out in transactions, but Capital Economics is saying that might have come to an end. Not only did the spike in mortgage rates prompt the housing boom to fizzle out in summer 22, they also pushed these market transactions into free fall mode. By December, mortgage purchase applications were down over 40% on a year-over-year basis. But there finally might be some good news for builders and for agents. Researchers at Capital Economics believe housing market activity is bottoming out. There are growing signs that the housing market activity may be close to a trough. The decline in mortgage rates over the past couple of months has led to a small improvement in affordability and a rise in home buyer sentiment, albeit from a record low. Corroborating this, mortgage applications for home purchase have ticked higher in the past couple of months, which should feed through higher sales, writes Sam Hall, property economist at Capital Economics. Okay, so this is really good news for a lot of people if these home sales are bottoming out. We're going to talk about inventory in just a second. This likely only happens if we get a little bit of inventory, but we've seen interest rates that have gone from the mid sevens now into the low sixes over the past 2 months. There's a lot of optimism that we could even get into the fives. There are many predictors that say we will get into the high fives throughout 2023. That as well would help some more buyers get off the fence and increase transactions if there's inventory available to them. Mortgage purchase applications, which has been on a free fall along with the sales transactions, is all of a sudden seeing a tick in the last couple of weeks. In this early January season, we're seeing an increase in these mortgage applications. Okay. And by the way, good news on the charts. There is a link below for the daily downloads, and you guys are asking for it. So we do have a link below for you to download all of the charts and the sources. There's one link where you can get all the sources and the charts. Okay. So mortgage purchase application index, obviously right here is the COVID. Here is when COVID came out. We've seen this huge increase in mortgage applications, nothing like what we saw during the last boom, the last real estate boom. And as mortgage interest rates went into the sixes, this line right here is the free fall. Now, as of just recently, we've seen this number tick up just a bit. And that's good news for demand, right? That's good news for the housing market, the inventory that is on the market, that there is an interest since January 1st in people buying homes. Okay. Just because U.S. home sales might be nearing a bottom doesn't mean we should pencil out a bottom for U.S. home prices, though. This is Lance writing in the article. Affordability will remain stretched, according to Capital Economics researchers. We think housing prices will need to fall by a further 6 or 7% to bring affordability back to a level that will support more normal levels of demand. Through October, the Case-Shiller National Home Price Index has U.S. home prices down from 2.4%, or down 2.4% rather, from the June 2022 peak. In 2023, Capital Economics expects U.S. home prices to fall 6%, which is a lot less than Goldman Sachs, which you talked about, predicting a 10% drop, while the average 30-year mortgage rate slips to 5.75% by the end of the year. So Capital Economics is on the 5% train. Peak to trough, Capital Economics expects U.S. home prices to fall between 8 and 10%. So that number there is closer to the Goldman Sachs estimate of 10%. And let's go take a look at home prices, where they sit right now in comparison to the peak. Okay, so they're calling Case-Shiller this 10% peak to trough drop in home prices, which we've talked about a whole bunch, right? Here we are. Let's just draw a straight line for 2020. We saw the sharp increase during the COVID years. Here's the peak. And now there are expectations that we will come down to this line. By the way, we come down to this yellow line, still well above any time period in terms of home values, as it dates all the way back to the year 2000. This line is well above home values in the last 20 plus years. So for homeowners, that would be very welcome news to see that, okay, even if it goes down 10%, I got 41% in the last year. I'm not going to lose all this equity that I've gotten in my, and I think a lot of homeowners and investors are going to like that if that does, in fact, come out to be true. Also, any recovery in housing market this year will be tepid. Okay, so this is Capital Economics research. So talking about, if we're going to see an increase in sales, it will be a tepid increase. Stretched affordability, a weakening economy, and falling house prices will weigh on this activity. So while we've likely bottomed out on this decrease in activity, it's going to be a small increase as we go up. It's going to be slow moving in 2023. As a result, we expect 2023 will be the weakest year for sales since 2011 and for housing starts since 2014. We could see, and there's going to be news on Friday that we'll be looking for. I'm about to get into Logan Matashami's housing tracker that he does every single week on Housing Wire. We could see for the first time in December, as they seasonally adjust, they adjust monthly, the first 3 million seasonally adjusted home sales, right? 3 million. Think about going back to the peak of 2006, 2007, where we saw over 7 million homes, where we saw over 6.5 million just recently. We could be in the threes as December tracks for total home sales. So that's speaking to that tepidness, but potential bottoming out of sales activity. All right, let's go to that Housing Wire article that I just mentioned. They do a a housing market tracker every single week. And what they've seen in the last week is good news for inventory. Weekly inventory adds 1,339 homes. Hit the thumbs up button if you're pumped about that. More inventory that we get on the market is going to bring some of these buyers off the fence in many markets who haven't found a house that suits their needs. Here's a rundown for the last week. Purchase application data has stabilized. The bleeding has stopped. So we saw the chart. We just looked at the chart. By the way, you can download all the charts in the daily download link below. All the sources, all the charts for the hot sheet, one link. You can get that down below. We saw the free fall in mortgage applications. We know that the last couple of weeks since January 1st, we've seen that actually tick up. Okay, there are agents across the country saying this, that interest, that showings, that even offers is on the rise since January 1. There's been a little bit of a light switch in terms of demand, okay? And they're referencing that here, that purchase application data has stabilize. That's a great indicator for the spring market, for the future. As people apply for mortgages, that means there will be more transactions potentially than expected in this spring market, or that there could be. Housing inventory increased by 1,339 homes nationwide. That's a small number, of course, but it could be the start of an important trend. We need inventory on this market to stabilize prices. The more inventory we get on, especially as we live in the low sixes and high fives for interest rates, we could see that 10% drop in home prices that Goldman Sachs is talking about, which could make housing more affordable for more people, which could spur more transactions for the industry. So it's important for us to get more inventory on. I know there are some pockets of the country that have seen a huge jump in inventory, maybe Phoenix being one of them. But overall, nationally, there is still a need for housing inventory, certainly at the median price points in almost every single market in America. Let me know in the comments if you're seeing the same in your market. Do you need more inventory right now? What type of inventory do you need in your market? Mortgage rates fell along with bond yields last week, showing that mortgage rates peaked on October 20th. Okay, so this is good news that we're seeing this type of data. I do want to show this existing home sales chart. It's very interesting. This is from advisorperspectives.com as of November 2022. It's in the Housing Wire article. They've sourced advisorperspectives.com, did a really good job showing here this existing home sale decline that we just spoke about. Okay. National Association of Realtors seasonally adjusted annualized rate of monthly sales. When I talk about those numbers in December, okay, where I say when December comes out, because remember, this is as of November 2029, we could actually see seasonally adjusted in the 3 millions for sales. Just a crazy, crazy number. Think about it. 2005, that seasonally adjusted number was 7.26 million homes. Obviously, we hit up over 6.5 million in 2021 right here. Still well below the peak of 2005. And right now we're trending at a low 4 million number. This is 4 million and 4.09 million as we sit here in November of 2022. You can see the straight line down in existing home sales, speaking to that earlier point about the transactions just completely bottoming out. But we may have hit our bottom according, again, to capital economics. So that is good news for the housing market. And listen, here's the number that I wanted to reference. Home sales taking us towards that level of 2007 to 2008. Home sales in general, it's rare to have monthly home sales below 4 million post 1996, but we have a shot of this happening as the NAR data will come out on Friday. So again, you can see this nosedive. We got down to 3.45 million on the second bottoming out here in 2010. We hit that below 4 million mark once in 2009. So 2009, we hit below 4 million. 2010 is we had our true bottom in real estate and we went down to 3.45 million. We could see that lagging data, of course, December, we could see that drop below 4 million here, but Capital Economics believes that we have hit the bottom and that we potentially could now be going up. Where do we sit year over year as it relates to this inventory? We're in a much better spot. Housing weekly inventory from January 6th, January 13th, 2023 was 472,000, while same week last year, we were at 283. Look at the trend last year. We actually lost inventory, about 10,000 homes, where this week we actually gained that 1,400 number, that 1,339 number. So this is good news for a market which has been starved of inventory for far too long, for a market that anticipates housing starts to be way down in comparison to what we need for new inventory. This is very good news for affordability. This is very good news for the market health overall. Hopefully, as interest rates normalize, stabilize, or continue to come down even a little bit into the fives, if you see mortgage rates come down into like the mid fives, 5.5%, you're going to pick up 5-6% on home values right there in terms of affordability. And then you see values drop anywhere from 5 to 10%. There you go. You could get 10 to 15% off of a house in terms of a buyer's affordability on these single family homes. That would help the market substantially as we move through 2023. What's not going to help Florida homeowners, specifically condo homeowners, is a bill that Ron DeSantis signed just this year. Okay, Florida real estate bombshell could destroy a whole lot of wallets. This is Fox Business. Florida Governor Ron DeSantis signed law last May aimed to protect condo residents in the wake of the Surfside collapse. So obviously we had the 12-story high rise in Miami and Surfside on the east coast of Florida, the tragedy that happened in last May when that building collapsed. Ron DeSantis last May, signed into law rather, that these condo associations must do 10-year repair costs, 10-year analysis. Okay, so associations are required to perform a reserve cost analysis every 10 years for repair costs that meet or exceed $10,000. Basically, anything on these buildings is going to exceed $10,000. So this is a cost analysis for everything on the building. We know how expensive it is to repair these buildings. Heck, if you're just a fixer and flipper right now, you know how expensive it is to just redo a kitchen, never mind a high rise and having engineers coming. So everything is going to be over $10,000, by the way. Associations must then mail their structural integrity studies to condo owners who contribute to the reserve together through an associated approved payment plan. Okay, to fund reserve pool of money, 50% or more of the total cost for condo repairs must be maintained. I have personally spoken to many real estate agents in South Florida, brokers, agents, and office managers who tell me the condo market is not only slowing down, but it is going to come to a halt as this law that Governor DeSantis signed in last May becomes a reality. There are going to be many associations that just can't fund the reserve fund required for these high rises, for condo high rises, to keep 50% of the cost in that study in this fund each and every year. So some people are going to get priced out. Think about it. Do you have an aunt? Do you have a grandma who owns a little condo on the east side or the west side of Florida right now? Do you have relatives who have maybe timeshares who have owned it for 20, 30, 40 years on these waterfront high-rise communities who don't have the funds to just go throwing a bunch of money into some type of pooled association fund where they can maintain this unit? So a lot of people are going to have to put their house in the market, which is going to drive condo sales down unless they figure out an alternative method. Listen, there's not going to be a lot of insurance companies that have empathy for this situation. They don't want to, insure a lot of these buildings as it relates to waterfront properties. Okay. And most of these high rises happen to be directly on the water. And a lot of these homeowners just don't have the money. And most associations, if you've dealt with condo associations, most of them don't have this huge pool of money sitting there for situations like this. Okay. So to fund a reserve pool of money, 50% or more of the total cost for a condo's repair must be maintained. Okay. So once they do that study, they're going to have 50% of the total cost of whatever that study says every 10 years in a fund just sitting there. Okay. Now, maybe they could talk to some financial expert and they can make some money off of that. But that remains to be seen how many of these condo owners are even going to have the money to maintain it. It's why there are some condo associations where you're like, oh my gosh, look at that condo unit. It's only $250,000. And then you look at the fees and the club fees, and it's like, oh my gosh, the fees are $50,000, $60,000 a year. I see that all the time in South Florida, and that could happen to a lot more of these high rises as this bill works through, or as this law rather works through some of these issues that are Florida Florida skyrise associations are dealing with. Okay, 10-year Treasury yield climbed this morning as traders await Fed speaker comments. Okay, so today we're gonna hear from the New York president, John Williams. New York Fed President John Williams is going to speak today. So you're seeing a little bit of a tick in the 10-year. And obviously on January 31st and February 1st, the Fed meeting is going to take place. And they will decide after 4 consecutive 75 basis point rate hikes whether to go to 50 basis points or 25 basis points. There's a lot of speculation that they could go to 25 basis points. If that happens, you probably see the 10-year drop. 50, who really knows what happens, but you are seeing today, as we come out of yesterday's holiday, that we are experiencing a slight uptick in the 10-year Treasury. It will be interesting to see what happens to the 30-year fixed mortgage rate. Obviously, we haven't had an update on that since Friday, January 13th, where we're at 6.09%. And we'll see what happens to the 30-year today as that 10-year does trickle up just a little bit, awaiting some of these Fed comments. Okay, today at 2:00 on The Real Word, we're going to be covering a Keller Williams lawsuit, which will impact every single real estate agent going forward. So make sure you're subscribed to this YouTube channel today at 2:00. The Real Word drops. You do not want to miss that. Please consider sharing the hot sheet with somebody who can benefit from it. And we'll see you back here tomorrow live at 9:30.